a game of making logical decisions. Irrespective of how well you make technical decisions, you still need to make logical decisions. And irrespective of how well you analyze, good analysis doesn't take away the risk of ruin. Good analysis with poor money management will still ruin your trading accounts. Good analysis with improper psychology, your accounts will still not grow. So it is very important that we have balanced view of trading. Trading is not all about looking at the charts and drawing lines, finding support resistance, order block, or whatever the method you actually trade. Now, irrespective of the method you trade, as long as it has an edge in the market, you can be profitable. Now, I'm going to actually pick a random section of the charts, pick like a good entry, and talk about how we can manage our positions when we are in trade. Now, first, if you are struggling with this strike rates, what you want to do is to make sure you take your analysis to a higher time frame. The reason why is higher time frame increases your probability to be right to an extent. So in higher time frame, you might not exactly hit your TP, but you will be right to an extent and you make profit to an extent. So in the case of building your account, it's not really a case of hitting TP, but it's a case of making money and adding to your account and growing the account. Now let's pick random points to analyze where we can see something like what we discussed in the technical analysis part of last week. So if you actually missed the last week meeting, you can go to YouTube and watch it. It's still there. So I don't really want to dwell so much on technical analysis because it is just part of the skill set. It is just one part of the skill set you need to develop to actually be a good and a profitable trader. So let me pick this particular section of the charts. This is 2022-04-17, and this is 4 hours time frame. Now I'm going to look for the same section in the lower time frame, which is 1 hour time frame. Right, so we have a session marked out. Let me look at the time. So this is 22 p.m. Now here we have the 22 p.m. Now what we can actually see from that specific point, a very simple structure. In the 4 hour time frame, you can see price created a low around here. If you are struggling to identify the low, you can just switch to line charts. So you can see that price did created a low here. Coming back now, expanding this same chart. Take note, now this setup is a 4 hour setup, but I am expanding it like to get more details and to refine the position to a lower time frame of 1 hour. It's not like I'm picking just 1 hour and trading off it, or maybe picking just a time frame and trading off it. So I'm looking at the fractal move of the market, move developing in relationship to different time frames. This session, this is the low here, the same low from the 4 hour time frame, the major swing low before this swing high, and then price traded below this major swing low. So this will be your break of structure from what we discussed last week. Your break of structure from what we discussed. Now, since you've established your technical part of this trade, the next thing is going to boil down to how will I manage this trade? So once price trade back into this range of this low to this previous high before this major low was violated, you are going to be looking for your entries. The next question is going to be, how are you going to manage your trade? How are you going to be profitable of this trade? The psychological part of it is this: you might be right and then still exit the trade with loss. You might be right, but not patient enough. That's part of being right, is all technical analysis. The other things I'm mentioning, they are all related to making logical decisions and your psychology of trading. So let's say you picked your entry from this specific point here. We traded very close to this point first time. So let's say somehow you got into this position and you sold. Now, after selling and running into some massive profits, you see price start retracing. And this is the point where you start regretting, I could have taken these profits. Now we have 22 points. So if you traded one lot, you probably will be seeing $22 profit. And now all of a sudden from $22, it went back to zero and even in minor loss. The psychological part is you might get pissed off or regret, and then you exit this trade. at the point of just trading back and intersecting this point. Psychological part, after trading back to this point and running out all of your profits, you will now be perplexed and leave the trade. After exiting the trade, you see the trade running massively toward your direction. And then you start regretting. Now, all of these, they will actually mess up your psychology the more. They will make you lose confidence the more. We want to focus on how are you supposed to manage these trades when you are in them. Something I found very effective to me is having a very close range for take profits. One, there is always this desire to take profits off trade that can be satisfied by taking any profits of the trade, actually, not closing the maximum position. So let's say I picked this point and took 10 points as my take profit one, not based on the chart now, but just agreeing to myself, setting the rule to myself that if this trade runs 10 points and I see profit from 10-point movement, I'm going to close maybe 50% of my trade and use the valid stop loss in this position. That is logic. Now, logic actually will help you to control your psychology better. You're not going to be feeling too emotional if your decisions are very logical. Now, let's say position management now. I've picked my entry and just 10 points, I'm going to take my first level of profit. So let's say I opened 5 lot size overall, and after 10 points, $50 profit. Now, it depends on how I want to manage my accounts. It's not actually a case of having screenshots to come back and show in social media. We all want to make money. That is why we are trading. It's not actually a game of proving I was right or I said this and it did this. Nope. It's actually a game of make money. I want to make money. I set the points that fine, if this trade just 10 points, I'm going to take some profit off the table. So after running 10 points year to year, I'm in $50 profit. And then I decided to take 2 lots off, which is $20. This is the original range of the stop loss. This actually is the original range. That's no assumption. This is the original range which you're not supposed to exit the trade from if it does violate you. So as long as we're still within that range, you should still stay in the trade. So we have 23 points there. Now, of these 23 points, let's say after running to these points, I took out, let's say, maybe 2 lots or 3 lots. Now, I've actually offset the risk that is involved in this trade. I've reduced the risk, not by closing the trade maybe in loss, closing part of the trade in loss, but by taking some profits out of the trade and increasing my account. Now, after seeing something like this, maybe after doing making a decision like this, if you have a small position, so let's say probably you close more than 50%, you can still use this valid setup. Do not be in a haste to always move your trades to break even. They will likely come back and kick you out and still continue toward your direction. And if those happen time and often in your trading, they are going to derail your psychology. This is the part a lot of people on YouTube and everywhere don't always talk about. We always glorify using tight stop loss, but it's not actually a case of using tight stop loss. It's a case of knowing how to manage the risk involved. Let me load calculator quickly and I'll talk about managing the risk involved in positions and not actually going for tight stop loss all the time. So looking at this position here, so let's say at the point of looking at this stop, this specific setup, I see that I have to wait for price to trade above this previous high before I will exit the trade as my invalidation level. So let's say this range, what am I willing to risk in this particular position? So let's say I want to risk maximum of $70. Now take note, it's not like I'm actually I am going to lose the $70, but I am willing to risk up to $70. This is the maximum I want to risk in this particular setup. Now all I have to do is come here, calculate the points, measure the point difference. So here I have 23 points, 23.6. Now, the logical decision, take note, logical decision for you to take here is to risk what you can actually afford to risk. That is logic. Another logical decision is to not exit the trade unless you are invalidated. Now, in most cases, we find ourselves exiting trades without the trade hitting our stop loss. We find out exiting the trade without the trade moving probably away from our entry, just probably around our entry. And that fear of probably you've been losing so much and now you finally see a trade running a small PNL, you just want to close. Now, all you have to do is actually to make your decisions be based on logic. Now, I have 23.6 points as my risk area. Maximum 23.6 points is where I will be invalidated. All I have to do is the amount I am willing to risk, which is $70 divided by 20. What was the point? That's 23.6. What I'm willing to risk is $70, and 23.6 is the point difference from my entry to my stop loss. Divide it and it will give you the position size that you are supposed to trade. So now I have 2.96. So this 2.96 is my lot size. This is logic. All I have to do is make sure here I arrange my positions of up to 2.9 lot size here. Now, I am willing to risk up to $70. That means I should be comfortable seeing this trade having a drawdown of -10, -20, -30, -40, -50, up to -70. Why? Because before going into the trade, I had it logically and psychologically that I can risk up to $70 in this specific setup. So I can actually withstand seeing the trade having a drawdown of up to that $70. Now, another way you can make logical decisions after spotting your entries is by using series of entries. Now, I have 2.9996 as my maximum positions. Now, last week, there was this method I discussed with my students using pyramid strategy of entering your trades. Now, you all know how pyramids look like, something like this, like this, like this. Fine. So when you are entering a bullish trade, you are going to build your pyramid. The base, like this, is where the strength of the trade should be. This means you have bigger position size here, normal position size, and small position size close to the top. Now, since we are selling, it means our pyramid is built upside down. So in a selling trade, it's going to be something like this. That means you want to start small, and as the trade continue moving up, you want to be increasing your positions. So right now I have, let's say, actually from our calculation, we have 2.966 lot size to trade. Now you can actually spread that risk across this whole section actually. Now, if you actually spread those positions across this whole section, you will not have a drawdown of up to what you are actually willing to risk if the trade goes your way. All your entries might not be triggered. So let's say at this point, after my initial trigger, I opened 0.5, depending on how I decide to build my pyramid, like how frequent I want to open more positions. So let's say maybe I open 0.5 here, 0.5, and then it trades up, or let me start with a smaller lot. Let's say 0.25, and then it trades up, runs against me. I open 0.5. That means I've opened 0.7 overall and trades against me. I keep on opening in that manner. Like the higher it moves against me, the bigger the lot. But the maximum lot I'm going to trade in is 2.96, which is the logical figure we arrived in from doing our calculation of what we can actually afford to risk in this position. Now, doing all of this will make you stay in the position actually. It will make you stay in the position even when you are in drawdown, because logic has it that this is where you are supposed to be invalidated. So your entry strategy is very important. Just imagine that this market trade to this point, and then you open like the whole lot size you want to trade at once. If it doesn't start trading toward your direction with immediate effect, you might begin to fumble. You might begin to lose confidence when you see probably after opening the position and then you see drawdown straight up to maybe minus 50. You're willing to risk 70 now, and then it shot up to minus 60 at once. You will lose good level of confidence. And then probably you start reducing the risk in loss instead of reducing the risk in either break even or profit. So you start reducing the risk in loss. Reducing the risk in loss means you are also reducing your account size. So your entry strategy is what should come in play here. One of the logical decisions you can make here is actually using this pyramid strategy, spreading your positions across that section. Now, if your psychology has it, that's fine. I want to go in with so and so lot, and I can actually withdraw, sustain seeing that drawdown, then it's cool. You can still trade it your way. But this is a suggestion, not a decision that you must make, but a suggestion of how you can. Please mute your microphone if you're not speaking. Everyone connected, please check your microphone and go mute. So we have tranquility in the call. Please mute your microphone. All right, cool. So this is like a strategy. Another way is probably just having multiple entries. So you can just go for, if you want to still trade, we're using this as our illustration here. So this is 2.966. So let's say divide this by 3. So I want to enter in 3 parts. All I have to do is entry 1, I open 0. What was our calculation? 0.98. It moves against me, I open another one, moves against me, I'll open the final one. That is the total of the 2.96 lot sizes I want to open. And my risk here is still the same, the $70 maximum. Now, it is actually beneficial when you have entries from different levels. Now, let us look at, so we picked here as our entry. Now let us consider entries from different levels. So let's say you picked here as your entry number 1. For simplicity of calculation, I'm going to just round up to 1 lot each because we have 2.96, which is approximately 3. So your entry number 1, you run it from your entry trigger down to this previous low. Let's say this is where you set your take profit. So from here to here. From here to here, we have 29 points. Now, let's say you actually did have multiple entries. You arranged your entries in different manners. So this is entry 1, and this is entry 2. Now, for entry 1, you can see it ran 29 points, and for entry 2, it ran 34 points. So actually having scaling into positions will help reduce your drawdown and maximize your profits. There are sometimes some position will retrace deeply against you. Probably you estimated that price shouldn't trade back to this previous high. But what if price trades and gives you a double top or a very close range like this? Now, having a trade, having an entry strategy, this is not just technical analysis strategy. Now, making all of these logical decisions can work irrespective of the model you trade. If you trade my model, it will work. If you trade trend lines, you trade this, trade that, trade with indicators, they will work. It's all about management and psychology. Management and psychology. Now, take a look at this. Instead of you being in a position here and having a drawdown up to probably this extent because price traded up to here, you will also have another entry here based on the fact that you did break up your entries, you did arrange them in the order of interest to you. Now, instead of just running 29 points, you have the privilege of running this trade 48 points, still to the same TP you would have run just this single position too. So can you see this? having scaling into positions can actually ease the tension of that is caused by your psychology of withstanding losses, and the other part of it, which is running the losses, actually seeing the P&L, seeing those negative P&L. So scaling into positions can actually be a solution. It can be of help in respect to these parts of trading. Now, you do not want to be overly focused on technical analysis. Actually, you don't start being consistent and profitable when you become better in technical analysis. You actually start making money. You actually start being consistent when you start making sound, logical decisions, and you can keep your psychology in check. A lot of time we find ourselves analyzing just the market. What about yourself? You're trying to conquer the market when you have not conquered yourself. So you are not in control of yourself, but you want to be in control of the market. It's a difficult journey actually for you to conquer the market without conquering yourself. So when you are in positions, you want to notice your reaction, how you act. What is your temperament towards this trade? Can you hold losses? Can you, even when you are trading what you can afford to risk, can you see your trading drawdown and still be comfortable and still hold on to those trades? Then the other part, logic, are you losing too much? Like when you are in drawdown, do you lose too much money? If you find out that you are losing too much money, then your problem is actually in over leveraging. That is, you are trading sizes that are too big. Sometimes we think we have to trade massive sizes to make massive profits, or for us to easily scale out of trade. You want to trade 10 lot size and then just exit after 2-3 points to make $30. But you can still make $30 with risking probably just $5 and running the trade as long as you can. Now, one of a trap and a fallacy to especially new traders is they all think they are scalpers. Every trader think he or she is a scalper once they come into the market. Why? It's simply the fact of needing to see frequent results. Now, in the game of consistency, trying to make money, you can claim to be a scalper in your demo account, but if you really want to have a high probability of making money, then you should learn how to gravitate towards the higher time frame analysis, making your decisions based on higher time frame setups and analysis. Why? Because higher time frame will increase your probability to be right to an extent. So let's say now this is, let me go to 4 hours time frame. This is 4 hours time frame. Any need for, okay, let me use illustrations here instead of going into different section of my chart. So let's say this point, okay, we're running out of time already, so I'm going to be quick with it now. So let's say this point, after seeing this move, and then you had your entry trigger around this zone. Now this actually is 4 hours time frame. This actually is 4 hours time frame. Now I'm going to load something from, yeah, exactly, lower time frame. Now we are going to measure just a swing in the lower time frame, and still same thing, just a swing in the higher time frame. So let me look for a very simple one to measure. Fine. So this actually is the most extensive swing we have on our screen. And how many points did it run? Run from here. Run from this high to this low. This is some 30 points move from, okay, 15 minutes is actually high. I don't even see a lot of those scalpers trading off the 15 minutes. So let me still narrow it down to something like 5 minutes on or 1 minute. Let me look for a good swing. Fine. So this is what most traders look at when trading. So let's measure, for example, this, which one is the best example here? Fine, so this here is an example. We have a swing low here, and then to this lower high to the right of it, and then a lower low, and then this lower high. Now, if you are trading off the 5 minutes time frame, you are definitely going to be targeting, if you know how to do your analysis, all you have to do is target a previous swing low as one of your take profits or your take profits level. That means irrespective of what was my entry trigger, I should be running this trade most likely down to this level because it is previous swing low. Now, if you actually measure this range, what do we have? From the maximum point of this range to the low of this range, we have 6.8 points. But if you go to a higher time frame, let's say something like 4 hours, and then pick a swing just like that. So we have a swing low here, and then this other one here. If you actually measure this from the high of this swing down to this point, which is the previous swing low here, which is the previous swing low, you can see how many points we have. 36. The other one is just 6. Now, if you have setups and you trade setups from the higher time frame, take note, you can actually expand your setups from a higher time frame, and then you can study them, expanding them to lower time frames. But the decisions are not based from seeing setups from lower time frame. Actually, it's a higher time frame setup that you did break down because the market is fractal, and probably you want to narrow down the move down to the point where you start seeing it moving before you jump in. Now, if you traded this is 36 points. So if you risked probably $10, you've made times 3 here. But in the other setup, if you risk, where is the setup? Fine. If you risk, okay, this is not it. This is still the 1 of 4 hours, 1 hour, and here 5 minutes. So let's say you risked probably $5 or $10 here. You still be making some massive profits. But now the problem is, yeah, because if you risk up to $10, if you risk $10 in this particular position, you'll be trading some massive lots because your stop loss will be tighter actually. So you still be making some massive profit. But the problem is decisions made on lower time frame have high probability of ruin and failure. That means your positions you pick from lower time frame, you have high probability of being wrong. Now, if, for example, that this position was wrong and we didn't hit this take profit, but it did close, let's say, maybe just 2 candles toward your direction and then reverse against you, that means you'll be running just 5 points. 5 points. So let's use a standard of 1 lot. So this means you run up to $5 and then against you. But let's also look at calculating with still 2 candles from a higher time frame, just 2 candles toward your direction. So candle number 1, candle number 2. This green candle, taking it as the number 1 candle there, and this red number 2. You can see you've run 28 points already. Now, take note, time is money. That means money is time and time is money. So if you don't have a lot of money, don't think you will bring $10 or $20 or $50 into the market and start scalping high frequency trades. Start scalping and thinking you will actually flip that account to 100, 200 in a few minutes. Fine, it is possible. You have chances of doing that. It's all probability. So there is probability that you can flip it. But for you to develop consistency in the long time frame, you need to gravitate toward the higher time frame. You will find it. You'll find out that profits are actually easier to come by from the higher time frame because you're actually giving the market time, which is equivalent of money. So you give time to the market, it converts it to money for you. Now, if you stay in a trade for just 5 minutes, there is high probability that after your entry, within the next 5 minutes, that trade might not move toward the direction of your profit. But if you stay in a trade for 4 hours or 8 hours, irrespective of how small the risk is, you'll probably see that trade running toward your direction massively, and probably even if it retraces against you, you would have seen some good level of profits. So it's very important as beginning traders, if you wish to develop consistency, Even if you want to be scaling out of trade quickly, make sure your decisions are based on high time frame.